All right, so today we're going to talk about a small company I own called Trac. And again, this isn't a recommendation to buy or sell. This is just me walking through my process. And in that process, when you are looking for stuff to buy, you're going to reject 99% of everything you look at and just keep turning over a lot of stones, and eventually you'll find something worth investing in. For most of your money, and for most people, the best strategy is just to invest in an S&P 500 index fund and just do that continually over time, and you'll do fine. And when you compare what you're investing into the S&P 500, which is the default, it should be a lot better than that. Otherwise, just keep putting it in the S&P 500. So historically, this trades at about a 15 or 16 times earnings for the index, which is capitalization weighted, meaning that big companies like Apple and Facebook represent a lot more of the index than smaller companies. But on average, for the index, it's about 15 or 16 historically. But now it's about 31, which is a lot higher than average. And it was higher than that in 1999 during the tech bubble. And it was higher than that in 2008 when the stock market crashed during the great financial crisis. But it's pretty high right now, 31. And that 31 includes very overpriced companies like Tesla trading at 250 times earnings and Palantir trading at several hundred times earnings. But the average is 31. So if we look at Trac, it's a very small company, 22 million. And honestly, you might not be able to trade this because this is not available on Merrill Lynch. This is not available on Robinhood. I was able to trade it on Schwab, and you can probably get it on Interactive as well, but it's a small company, so it might not be available on your brokers to trade. But sometimes with these obscure names, if there's things that keep other people from investing in it, like the size or where it's tradable, that can help. So this is available on Schwab, but not on Merrill Lynch. And there's another company I own, which are the preferred shares of POWW. So it's POWWP, and that's not available on Schwab, but it is available on Merrill. And this is not available on Merrill, but it is available on Schwab. So sometimes it pays to have more than one account just so you can trade everything. And there's many companies that aren't available on either of those two, which are available internationally, and Interactive Brokers is usually better for that. And I don't have an account with them, but I'm just letting you know. So anyway, if we compare this to the default, 13 times earnings, 13.6, that passes the first hurdle. And this company has almost no debt and a lot of cash, 8 million in cash. So it's 22 million, but if you back out the cash, you're looking at about 14 million. So about a third of the company's market cap is in cash. So if a third of the company's market cap is in cash, this isn't the real PE ratio. If you knock a third off of that, then you're getting this at less than a 9 PE ratio. So a PE of 9 versus a PE of 31, so far so good. But a lot of times when you find something with a low PE, it is a cyclical company that sometimes does great and sometimes does poorly, and you just have to catch it at the right time. Or sometimes it's a melting ice cube. It's trading at a low multiple because the company is doing terrible and eventually will go under. This isn't the case with this. They have a lot of cash, as I said. And as Peter Lynch said, it's pretty hard to go bankrupt if you don't owe anyone any money. And they are growing, but it's a small company, so it's not on most people's radar. So what do they do? It's a specialty software maker. And a lot of times you'll find these companies in very niche markets where it's not worth it for the big guys like Microsoft to compete with them. And there's actually a company called Constellation Software, which has a great business where they buy up these companies doing niche software that nobody's interested in and just keep them all under one roof. So this company actually provides casino management software for the gaming industry. And what's interesting about this company is that it has a moat. And what's the moat? So they don't produce games, they produce casino management software. So cash management, player rewards, things like that. They have something called CasinoTrac, which you can look up. And this has a very interesting moat because in the US, if you want to be in a casino, you have to get approval from the State Gaming Commission for your software, for your hardware, whatever you use, even casino management software has to be approved by the State Gaming Commission or the Indian tribes. And this has approvals in Nevada, New Jersey, all these other places. And when you are looking to sell this abroad, that is a pretty impressive seal of approval if you've got the State Gaming Commission approvals. So their main competitors are companies that offer gaming machines and things like that, and they throw in the casino management as a gimme for you buying their other stuff, but their TableTrac stuff is good enough that people will buy it separately. And whereas the other stuff from their competitors occasionally gets hacked, and that's horrible for a casino, it's devastating. TableTrac's software has never been hacked, and it's written in an old programming language. I can't remember if it's Fortran or something like that, but it's something that's not used very often, but banks use it. And it's very difficult to hack because it's very reliable and stable. And also, since not many people use it anymore, it's hard to find a programmer to program anything in this language. And so if it's hard to find somebody to program in this language, it's really hard to find somebody who knows it well enough to hack it. So that's a plus and minus. If you wanted to make changes to the software, it's hard to find people to do it, but also it's never been hacked, and because it's such a stable platform, it probably won't be, but that's a double-edged sword, as I said. But anyway, a nice moat because it's a small industry that's overlooked by a lot of bigger companies. It has a moat because even if somebody did want to get in this industry, you'd have to get approval from the State Gaming Commission in any state where you want to sell this to a casino. It's got a ton of cash, so it's 23 million about, let's say, market cap. But if you back out the cash, a third of that is cash. So not only is it trading at a low PE, if you back out the cash, it's really about a PE of 9 versus 30 for the index. And another drawback is that it is not very liquid. So there's generally a big spread between the bid and the ask. So instead of $4.75 bid, $4.76 ask, it's $4.75, $4.85. It's a pretty wide bid ask spread. The volume is very low, 804 yesterday. So if you were to buy this, and I'm not saying to buy it or sell it, I don't give recommendations here, I'm just talking about my process. But when I buy small capitalization companies like this, I would never use a market order. You got to put a limit order, and I would specify the price I'm willing to buy. So maybe I'll put in a bid at 476, and sometimes I'll put in a bid, and I kid you not, I'll put in a bid at like 460, 450, and it'll go like 2 or 3 weeks before I get a fill. And that's fine. Just I would put in a bid 476 and go on with my life, and then if I get a fill, fine. If I don't, I don't. But I don't want to chase things, and you especially don't want to ever chase a really small cap like this, because you buying even $10,000 or $20,000 worth could move the price. And if you're buying hundreds of thousands of dollars worth, you're going to move the price a lot, and then when you try to sell, you'll move the price down. So it should be something that you only trade with a limit order if you do, in my opinion. And if you were to buy anything that is a small company like this, you should be willing to hold for a very long time. And you should know that if you did want to get out, it might take some time to get rid of your shares. But also, yeah, you want to, if you're going into this shallow of the pool with in terms of market cap, it should be something where you're willing to hold for a long time and you don't think it'll go under. So something with a third of their market cap in cash is something that's unlikely to go under. And as I said, they have this regulatory moat because of the casino approval. So, that's just something to think about. In terms of other companies with a lot of cash, I think I mentioned this yesterday. So this is another one which is pretty cheap, 16 times earnings, and they make dampers for drones and buildings. And if you look at this, 142 million market cap, and then if you back out the cash, that's 105. So they have a ton of cash, no debt, very conservatively run company. And when you're under $1 billion, that's what you want to see, is very conservatively run companies that have a lot of cash and trading at a low PE, because you might have to sit on them for a while because they are generally not looked at by bigger trading houses. And so if you turn over a lot of rocks, as I said, you might find bargains, but 99% of the stuff you turn over is unloved for a reason. And so you just have to look at it and quickly move on. But anyway, that's my process and how I came across TableTrac. Nothing new there. So I tend to stay away from fad stocks that are in the news like Palantir or Tesla, and just go with traditional value investing or growth at a reasonable price. But if you have any questions on this or any suggestions, just leave a comment below. And if you want to support the channel, there's a Buy Me a Coffee link there, but don't feel like you have to. And have a great day, everyone.